Good evening. Welcome to the Ayurveda webinar on model asset allocation. Asset allocation is one of the most important decisions that investors make. Our speaker today, Mr. Snyder Albicus, will take you through the basics of asset allocation. He is a member of Research and Product Development team of Ayurveda Asset Management Company and has an MBA from Xavier's Institute of Management and Research. You may ask questions once the presentation is over. Over to you, Snyder.
Ladies and gentlemen, very good evening, ladies and gentlemen. We'll be talking about model asset allocation today, and I'll be just running you through the basics of how one needs to go about selecting their assets in terms of investment. There are a lot of factors that involve investing in assets. Number one being risk, number two being age, etc., etc. Now, if you look at the first slide, there are a lot of asset allocation involves investing in equity, debt, basically being the two major factors where as of today most of people invest simply because they are unaware of certain other asset classes and they do not have too much knowledge, nor more exposure in other asset classes. Basically, if you run through the first most favored ones, equity and debt. Now, what happens is there are a lot of theories, doing the rounds in the markets, and I've particularly selected a theory that is the 100 age rule, which most of you all have would be aware of, which is basically taken as a thumb rule across the investment world, across the globe. Investment bankers, in fact, also recommend this rule to the investors on a large scale. The thumb rule basically is that 100 minus age, 100 minus whatever age you belong to, age bracket you belong to, you invest a major chunk of that in your equity portfolio, and the remaining is your debt portfolio. For example, if you are at the age of 30, so you invest 70% of your portfolio, you take an exposure in the equity, and the remaining 30 would be on the debt front. Ideally, why has this been conceptualized? Simply because, at a very young age, you have the capability to take a larger exposure and a larger risk factor, in fact, hence, for larger returns. Hence, you put major chunk in equity, and equity being most favored and highly volatile, there's a major chance of higher returns going forward. Stocks have historically had the greatest risk and highest returns among all the other asset categories. The volatility of stocks, however, makes them a very risky investment in the short term. You'll agree when I say that sometimes the loss has been dramatic. However, if you see the long term, given the volatility, investors do make a lot of money in equity. Debt, on the other hand, is moreover to balance the risk that you are taking on the equity. Less favored stocks, on the other hand, are real estate, bullion, primary business, and alternate asset investments. What are these? What am I talking about? Real estate, basically, when I mean, I'm not talking about your primary place of living. I'm saying apart from that, whatever investments you make in the real estate segment is your investments, what you need to consider. Ideally, simply because your primary place of living is not your investment. It's a place where you're going to spend till your retirement. However, after your retirement, you can consider this particular asset class as an investment, simply because you can always move to a much less sophisticated place and use your previous property as an investment. Bullion, on the other hand, is a very important factor. I'll come to that later, and I'll just explain maybe later how bullion plays a very important role in terms of asset allocation. Alternate investments, when I say, I mean unlisted equity, derivatives, hedge funds, farmland investments, so on and so forth. This is this has been more unconventional in a very long span of time. Having said so, there is a lot of potential being seen in these particular categories in the recent past, and the various governments have been involved in encouraging sectors like your farmland, agricultural fund, infrastructure fund, so on and so forth. Primary business is another very important factor that people do not consider. Ideally, primary business also happens to be a very important investment tool. Say, for example, you are at the age of 30 and you have another 30, 40 good years ahead of you. And you've got a huge chunk of money. You want to know where you want to invest that kind of money. Investing that money in your primary business will only help you to do justice to that business and to do justice to that investment in terms of the growth and in terms of the returns. So instead of putting that chunk into maybe equity or real estate, you could have rather put it in your primary business and earn 2, 3, 4 folds on a year-to-year basis. So this is basically the various asset classes that one needs to look at while taking an investment decision. Now, investments, however, in these asset categories typically have categoric risk. Before you make any investment, you should understand the risks involved in each of these asset classes and make sure these risks are appropriate for you. Let's look at asset allocation and with the diversification that is involved within them. Asset allocation within a diversified portfolio, as it mitigates the risk which otherwise would have been higher. What happens is, if it's just a simple concept of not putting all your apples in the same basket, just putting your apples in different baskets help you to mitigate the risk factor that is involved in one specific asset class. Let's take equity for example. If given that you put 70% of your investment in equity, what is very important is to understand and to identify what kind of stocks are you looking at putting the money in. Simply because the equity investments are very sensitive to risk, and if you just do not select the right company, then your investments would be in deep trouble. So a couple of factors one needs to understand while investing in equity. Probably I wouldn't get into stock specific, but I can always recommend one to look at early mover advantage as far as companies are concerned, companies with long growth track record, good corporate governance, and companies that have been able to give an incremental growth in returns over the last 10 years, 15 years, or probably since their existence. Hence diversification. A diversified portfolio, as I mentioned, should be diversified at 2 levels between asset classes and within asset classes. So equity was one of the examples I gave you. Debt and so on and so forth are other examples. Debt, if I talk about debt, you could invest in bonds, you could invest in government securities, etc., etc. Just highly recommended is to, according to your risk appetite, you should make sure where is your money going. So on that basis, I suggest that diversification plays a very important role in terms of asset allocation and will definitely reward you 10 years, 20 years, 30 years down the line whenever you plan to retire and look at returns coming back in those various categories. Go to the next slide. How does one rebalance the portfolio, and how important is it to rebalance the portfolio? Rebalancing is necessary because over time some of your investments may become out of alignment with your investment goals. When you rebalance, you'll always need to review the investment within each asset allocation category. If any of these investments are out of alignment, then all you need to do is rebalance it simply by figuring out which investment or which asset is undervalued at that given point in time or overvalued at any given point in time. What I mean to say is, if you rebalance your portfolio, say once a year or once in 2 years, you will at least be able to understand if the asset class that you've invested in is currently overweight or underweight. In case it's overweight, then it makes sense for you to sell it and move on to another and invest into another asset class which is underweight, and vice versa. Rearranging a portfolio helps you in identifying the various volatile scenarios within various asset classes. So hence, rebalancing a portfolio plays a very important role in asset allocation and in investment. Next slide. Well, the other side of the coin, what I mean by the other side of the coin is there are a lot of factors that a lot of investors overlook while investments. Ideally, exposure to just equity or debt, exposure to either equity or debt wouldn't suffice in the long term. One also needs to look at other asset classes and what kind of limitations or what kind of advantages one would have in terms of investing in other asset classes. Take insurance for that matter. What is highly recommended is when you look at insurance, you either look at a term plan or a health insurance, simply because it is insurance, not a typical investment on returns in the short term. And for that matter, ULIP is a total no-no, simply because at the end of the day,
the broadcast is now starting. All attendees are in listen-only mode.
Yeah, sorry for the interruption. So if I was talking about ULIP, you have allocated XYZ amount to various asset classes, and then you invest in ULIP as well. What is happening is your money is coming back to the same investments, to the same asset classes, because these insurance companies, through that ULIP plan, invest back into the market or back into the debt market. So one needs to figure out what exactly, needs to sit down and analyze and figure out what exactly do they want to invest in, and the time span, more importantly, and the risk factor, most importantly. Investing in bonds yet is another, I wouldn't say risky affair, but I would say one should be very careful in investing in bonds as well, because it's not always safe to invest in bonds. Say for example, inflation plays also a very important role in terms of your bond market. High inflation will lead to low yields, and low yields would lead to high bond rates, which means that ideally if inflation keeps rising, then your bond rates would eventually move up, and investing during that time would be a very costly affair, simply because once inflation has been taken care of, then your bond rates will drastically fall down, which will finally have a toll on your overall portfolio. Bullion, like I mentioned in the earlier slide, bullion investment in India is one of the most important. However, it's not been totally given that kind of recognition, simply because, take gold for that matter. Gold has a very sensitive connection to the Indian population, and given that today, if even 2 or 10% of Indian households invest in gold, they are not aware of the fact that that investment, what they have done for maybe a traditional reason or something connected very close to the heart, that happens to be one of the most effective tools in a crisis situation, in a situation where the economic condition cannot be handled by the government, so on and so forth. So in that sense, bullion also plays a very important role. Hence, one should not forget, and one should always keep at the back of their mind, that investing in bullion doesn't just mean trading. We mean invest and make sure that 5 to 10% of your portfolio has a bullion aspect to it. Asset liability mismatch. What I mean by this is, a lot of people have a lot of plans going further, but they do not understand what kind of funds do they require maybe 10 years, 20 years down the line when they're retiring, or maybe when they're getting to marriage age. So what happens is, if my asset, when I'm saying asset, I'm saying from an individual perspective. An asset is your income, and your liability is what kind of expenditures you have right now and what kind of expenditures you are anticipating in the future, taking into consideration your inflation and all the other economic factors, all global factors. So one needs to understand whether there is an asset liability mismatch right now, looking at your future prospects, looking at your future goals, looking at your future needs, and accordingly invest or manage your income in such a manner that 20 years down the line when you retire, you're sure enough to have returns coming to you, in tranches in a very systematic way. So just to sum things up over here, what we are trying to say is we're not specifically talking about investing in A or B asset class. The principle and the objective of this presentation is to make you aware that there are different asset classes one needs to look at in terms of investment, and one needs to figure out what are their priorities, according to which they will, they have to make investment decisions going forward. Thank you very much. We are open to question and answers. Well, the first question was from Mr. Abhishek Bhagat, and his question was, what is an appropriate asset allocation with respect to different ages? Abhishek, that's a great question to ask. Yeah, just to answer that question, see, like I mentioned earlier, we are here to make you aware more than specifically give you, probably a ratio as to where to invest certain, all your funds in. But to be specific to your answer, let's take for example, you are a 70-year-old businessman. He, his needs, his requirements could be different from a 30-year-old from a 30-year-old person or a 30-year-old businessman. What I mean to say is, over a period of time, things have evolved. People have evolved. Standard of living has evolved, and different asset classes have evolved in terms of returns. So for a 70-year-old businessman, to answer your question, for a 70-year-old businessman who probably has, 2 kids who are doing extremely well in terms of income, who've got their own business setups, or maybe who are service oriented but are still doing well, his needs will be totally different from maybe a 30-year-old businessman. A 30-year-old businessman would focus probably more on investing in his personal primary business, what I had mentioned in my first slide. And so for this 70-year-old businessman, even putting 100% of his investment in equity, he can afford to take that risk, because he's already got what he's achieved. His children are, all by themselves, doing well by themselves as well. So his risk factor increases drastically automatically. So this is one example. So hence it becomes very difficult to specify an appropriate asset allocation with respect to age. So there are a lot of different other factors like demographics that are involved in investment. So being specific would be very difficult for to answer this question.